Back to that decision by the Bank of Canada to hold rates steady at 5%, only the third time in the last 18 months that they have opted not to raise borrowing costs. But the Bank of Canada, in its statement, talking about some of those signs of excess demand cooling. And certainly recently we saw GDP in this country contract in the second quarter when Bay Street and even the Bank of Canada itself were expecting growth. David Doyle is head of economics at Macquarie, and he joins us with his reaction. David, great to see you. I don't think it was a surprise to Bay Street that the bank would hold rates steady. What was your reaction?
Yeah, I think that statement was pretty much in line with what the consensus had anticipated leading into today. So you had a pause, but alongside that, what we would call a hawkish bias. So the BOC, Governor Macklem, still dangling out there the possibility that the BOC may need to move further in October or December.
And the reason for that is that despite cooling effects for the economy, inflation still isn't at the levels that they would like it to be.
That's right. It's the combination of deteriorating growth. So we've had, a slowing in real GDP, as you highlighted at the outset. You've also had the unemployment rate rise for 3 consecutive months by 0.5 percentage point. But despite those indicators of cooling, you still have firm underlying inflationary pressures and unit labor cost growth that's running 5 to 6% year over year. So I think the BOC is right not to be completely abandoning its hawkish bias at this meeting.
So you had been predicting a cool down for Canada's economy. You'd been warning about how our household debt levels could put Canadians in a tricky spot for some time. Where do you see the economy heading from here, and how do you think ultimately, outside of language the Bank of Canada is providing, what they will be doing going forward?
Yeah, so I think right now is a pretty tricky time for Canada. You had the contraction in the second quarter. It looks like the handoff to the third quarter was pretty weak if you look at some of the details of the StatsCan release. So that suggests to us that you're looking for probably another flattish, call it, third quarter. But as you look to the fourth quarter, potentially there's a rebound happening. But I would say that would be largely mechanical, driven by the wildfires season coming to an end. That I think has been a modest drag on growth. And then as we look to 2024, we're actually looking for potentially further contraction occurring throughout that year as those effects of household debt and the interest burden being imposed on Canadian consumers starts to bear out even more so in the actual economy.
Meanwhile, what do you make of the fact that politics is entering the central bank ring here? Coming into this decision today, we'd already seen at least 3 premiers call on the Bank of Canada to stop raising interest rates. And interesting, very quickly, the finance minister today describing the non-action by the Bank of Canada as welcome relief. Obviously, the central bank is independent, but if many Canadians are starting to feel a sting from higher interest rates, does that surprise you?
Well, it doesn't surprise me to see the political theater take place. I think that, politicians are inclined to grandstand in that way. But I agree with you. I think the Bank of Canada remains independent. I don't think what the premiers or the finance minister say will have much effect at all on what Governor Macklem is inclined to do.
And I mentioned in the markets, because it is a tricky time, you start the day with worries about the global economies, some weak data out of Germany. As we move through the day, a storyline around a resilient U.S. economy also creates some worries in the market, the idea that the U.S. will keep rates higher for longer. So how does Canada fit into that story of what the Fed does from here?
Yeah, certainly you've had some bifurcated developments, across the world in terms of growth. I think to the extent that you see a resilient U.S. economy, it probably gives the Bank of Canada some confidence that growth in this country, while it might deteriorate, it may not be as bad as it otherwise would be because you can rely on that strong trading partner we have to prop up our growth. And on the other hand, if you do see the U.S. start to weaken from here and start to soften, potentially that makes Governor Macklem and the Bank of Canada even more concerned about Canada's growth outlook than they already are. For example, we had that contraction in the second quarter in Canada, but that was despite very strong activity in the United States over that period. So it calls into question, what will happen if the U.S. starts to slip?
And when you look at the legs of the stool going forward, we touched a little bit on housing. How closely are you watching the employment picture from here?
Extremely closely. I think at this point it's actually a critical juncture for the labor market in Canada. It's very rare outside of recessions for unemployment to rise for 3 consecutive months like we've just endured. If we see unemployment rise further from here, it will start to potentially signal that Canada may already be in a recession. It's quite uncommon for unemployment to rise more than 3 months outside of those recessionary periods.
And so I guess if those numbers were to play against the Bank of Canada's hope for call it a soft landing, would that open the door to more talk on the street, say towards things like cutting interest rates heading into next year?
I think possibly you'd probably see certainly some more market chatter, some more reports that's just suggesting that could be the case. But I think the Bank of Canada is, almost zero focus just on the inflation picture. Sure, they'll keep in mind what's happening with growth, what's happening in the labor market, but their number one job is inflation at the moment. So those numbers, I think, matter more than anything.
Okay, well.